Good morning, everybody. My name is Ann Cadle. I am the marketing specialist at MAR. I want to thank you for joining us today for the monthly housing market update from the one and only David Arbit, our Director of Economics and Research. Few things before we get started. This webinar is being recorded and it will be available on our website in the next 24 hours, as well as an email will be sent with the recording and slides to all the registries. If you have any questions throughout the presentation, feel free to use the chat or the Q&A functions when you hover at the bottom of your screen. We will try to get to some throughout the presentation, otherwise we've saved time at the end to answer those. And with that, I will hand it over to David.
So just as we're getting going here, I just want to say thank you to Ann. Ann is, I guess, a relatively newer member of our team. I don't know how long I can keep saying that, but she's just doing a tremendous job and we're so grateful. So thank you, Ann. You are the best.
Thank you, David.
All right, and everyone else, we're pretty excited that you're here with us. I see some new names in there and lots of old ones. Not old in age, but old that you guys have been here. Just want to be clear on that. So yeah, we're going to give you guys a little bit of an update. We're going to talk August numbers, and it's going to be pretty exciting, and we're really glad to have you all here. So as we do, we always like to say a thank you to our sponsors, without whom this wouldn't be possible. So thank you to Bell Bank Mortgage, thank you to North Star MLS, RCU Royal Credit Union, used to be Realtors Credit Union, and then I guess they wanted to expand their reach, and SupraKey, one of the more innovative providers or vendors in the key space. Just a quick story about North Star. I don't know if you guys all know just how big of a rock star John Mosey is, the director over at North Star. Back when we used to leave our houses and go to conferences and things and see people and shake hands, I know it sounds foreign. John would have a whole line of people lining up behind him, John Mosey would. And people were asking, how did you handle this? How did you do front end of choice? How did you do MLS 2.0 policy? What about this vendor? How are you guys such a leader in this space? So we are so fortunate to have one of the most forward-thinking and innovative MLSs in the whole country. And I'm honest to God, not even exaggerating a little bit. All right. So we still have our Realtors Rebuilding community page. We encourage you guys to check that out. That is on our homepage. You guys can see the URL as well. And then, as we've been mentioning, we still have our MAR COVID-19 resource page. Tons of great resources there. I know some of you have checked that out, but please do if you haven't had a chance. And then just a little bit of a rundown of how I'd like things to proceed today. So we're gonna spend most of our time in this market update section. We're gonna do some short-term trends and then pivot into some longer-term trends. I'm actually kind of excited about the longer-term trends. The short-term trends are fun and good and interesting, but I think the longer-term trends could be even more telling. As you guys have been requesting, as we've heard from members, we're going to focus in on Minneapolis-specific activity. And then if we have time, which I'm afraid we might not, we'll jump into some market reports and InfoSpark. So if you guys will humor me, brace yourselves, data analysis is coming. All right, friends, let's start off with the market. So 3 overarching trends before we dive in, just to kind of get everyone on the same page, get our thinking caps on. Buyer activity is strong. I might even say buyer activity is relentless. Listings under contract, what we call a pending sale, are at their highest August level since 2003. So higher than any August in the last, 17, 18 years. So pretty impressive there. Even though our records only go back to 2003, that's sort of our data valid as of date. Our data is only valid as of 03, not before. So it's likely since 2000, but all we can say with certainty is 03. So that's just for August, right? The highest overall level, last month was the highest overall level for pending sales since June of 04. So a pretty impressive figure there as well. Seller activity is still weak. Sellers are still listing fewer properties than they did last year overall, even though August did see a very slight bump, and we'll jump into that. As I think everybody who's listening to my voice is well aware, inventory is by far the biggest factor that's holding back sales and frustrating buyers. We're still hearing people who've made 6 offers and have been beat out every time. I even heard the other day that a $400,000 listing sold for, $420 or $430. So even above 300 or 400, still pretty competitive. I think that was the exception and not the norm, but maybe your experience might vary, your mileage may vary. So active listings, or the number of homes for sale, have declined 66% since 2010, while sales and population have only increased. Okay, so that kind of sets the stage a little bit. So mortgage rates, let's just talk mortgage rates just for a few minutes. You guys will see Forbes, mortgage rates, record low. Yahoo Money, mortgage applications, 33%. Rates, record low. WaPost, mortgage rates, just hit a new low. Again, Forbes, mortgage interest rates, fall to their lowest rate ever recorded. Again, I think you guys are getting the picture here. So let's dive in. Let's dive into our 30-year fixed rate mortgage. This is national. This is not necessarily Minnesota or Twin Cities. You are not dreaming. You are awake. Yes, the 30-year fixed rate mortgage is below 3%. It's 2.87 nationally. You guys can kind of see ever since they almost touched 5% at the end of 2018, they've really been on a downtrend ever since. And just kind of beating this dead horse a little more, please note, guys, the last time prices were this high in 06, look at where rates were. About 6.75, call it 6.5. And now they're below 3. That is a greater than 50% decline in rates. And Jerome Powell, Federal Reserve Chair, has hinted at markets that rates are going to be low for some time. A little bit of trivia here. Who knows the long-term average on that 30-year fixed rate? So going all the way back to 1971. So this is a half a century of mortgage rates, right? 50 years of mortgage rates going back to 1970. Some of you will remember 17, 18% interest rates. What a steal of a deal. Don't forget, guys, people were lining up around the bank to get mortgages, right? You couldn't really do it online. I think you had to physically go. So again, a little bit of trivia here. The long-term interest rate, the 50-year average on a 30-year mortgage rate, it's about 8.2, 8.1, 8.2. So anything below 8% is really a below average interest rate. And we're already below 3, and I would suspect we'll be below 4 for at least a couple years. So obviously this has kicked off a wave of refinance activity. This is from the Mortgage Bankers Association. You guys can see as rates went below 3%, it kicked off a wave of refinance. It looks like the third biggest wave of refinancing in 30 years. So it really kind of is fairly historic. All right, let's shift out of rates a little bit. Let's look at purchase applications. Again, this is from our friends at the Mortgage Bankers Association. This is a tremendous leading indicator, you guys. And we're going to talk about in a moment sort of what leading indicators mean, which ones they are, and how they can help us understand what's happening. You guys can kind of see at the peak of 06, purchase applications, then we kind of rode the wave down, stabilizing around 2012, 2013, and then we've been heading up since then. As you guys can see, COVID clearly made a mark here, has a little signature there, and the signature is a V-shape. So purchase applications do seem to have made a V-shaped recovery, which makes sense that when we look at existing home sales, we also see a V-shaped recovery. Now, let me pause here. I am not saying that the economy will have a V-shaped recovery. What I am saying is that mortgage applications and existing home sales at a seasonally adjusted annualized rate both seem to have made a V-shaped recovery. As promised, let's talk just for a minute about the life cycle of a listing. And as I said, a note on leading indicators. So for sellers, first their listing is new, and then it's active, and then it goes under contract or pending, and then it closes. So for buyers, typically you have a Google search or, listing traffic, then you have a mortgage pre-approval, then you go to showings, then you write offers, then you close. So if you want to know, if you want to know what's going to happen with actives down the line, we'll look at new listings now. If you want to look at closings down the line, we'll look at pending sales and showings and mortgage applications. Or how about this one? If we get even earlier in the process, Google search traffic. 05 through, what is this, yesterday? We're still 2020, aren't we? I think so. Google Trends. So here's the search term, buy a house. What's the popularity of that search term since 2005? Seems to be at all-time highs, right? At least within the last several months it was. So this is index, so 100 is kind of the highest value. What if we throw in get a mortgage? Also about as high as it's been maybe since 07 or 08 here. What if we throw in realtor? Interesting. 100. So the search traffic for the word realtor, or the popularity of that search term, is about as strong as it's been since 2005. That's kind of saying a lot. It's good news for you guys. All right, so let's switch gears just a little bit. Part A of this section is going to be looking at some daily, weekly, and shorter term trends, and then we're going to shift into our longer term trends. I need a sip of my tea there. So looking at daily showing activity, this is one that we've been watching really since COVID. We have this year current levels for 2020 in blue, and then we've got our year ago levels in gray. You guys can see the COVID impact pretty clearly. Again, very much a COVID signature there. So here again, the showings do seem to have also made a little bit of a V-shaped recovery. Maybe you can call that a little bit of a skewed W, but let's not split hairs here. So once showing activity sort of got back on track with 2019 levels, you guys will notice it's been hovering above those year ago levels for some time. You guys can see dips. What is this? 4th of July, Labor Day. What is this? Thanksgiving, and then you guys can see the holiday season. So, there are some dips that kind of follow those holidays. Pretty positive news that showing activity has remained above, has hovered above those year ago levels. The question is, can we make up here some of the lost ground from here? It looks like we're getting there. And we're going to look at some year-to-date stats that kind of compare us to those prior years as well. Okay, overall showing activity by price point. So this is for the current week that just ended, well, through earlier this week through I think Sunday, and then the week ended the same day last year in 2019. So I think the big takeaway here, we see declines in showing activity in our most affordable segment, 200K and under. And then we see growth in every single other price range above 200,000, including over $1 million. Looks like some of the strongest growth was here in our $250,000 range up to 300,000. So I just want to talk for a minute about this product mix effect. And I may reference this later. So just because the median sales price rose 10% doesn't mean every home is worth 10% more every year. So sometimes if you see the market skewing toward these higher price points, I think of that as the product mix effect. As we have fewer products under 200K selling, and we have more product over 6, 8, and over $1 million, obviously selling, sometimes that can skew prices, but that's not necessarily supply and demand driven. Yes, supply and demand drive market prices and market activity, but it's also the mix of homes that happen to sell in a given month. So just want you guys to be aware of that. I know I've talked about that before. So we were just looking at the number, but how about we look at the percentage or the market share, the share of overall showing activity? What this is saying is out of 100 showings, let's say we had 100 showings, 30 and a half of those would be on listings under 200,000, but that's last year. This year, look at how this segment is in demand, is in such high demand and such low supply. Only 20% of showings were on these most affordable listings this year. So 30% last year down to 20%. Clearly we have a change here in our most affordable segment. A little bit of a dip in that next leg up. Nice gain here in 250 up to 300. And then we have gains all the way up. So last year, showings on million plus homes were only about 1.45% of overall showings. This year, they're 1.72%. All right, I don't want to split hairs, but interesting change there. So speaking of change, let's look at that change in showing activity. Here's our segment where we see declines in 200K and under, and then our biggest gainer seems to be in the 600 to 800,000 range. Overall, showing activity was up 20% from last year. And you guys can see some really strong numbers here, some really nice growth in showing activity from last year, as we've been capturing for months now. Okay, so let's pivot out of showings a little bit. Let's talk about new listings in the metro. We've got 2020 in black, and then we've got the previous 3 years in these different shades of blue or purple, if you will. So new listings this year, we're looking pretty strong, and then COVID hit and the lockdowns hit in mid-March, and we can see seller activity decline since that executive order from Governor Walz. Activity did get back to those levels, I guess relatively quickly, but really since then, we've kind of flatlined a little bit and we haven't gotten back to the levels that we've seen for the prior 3 years. What's interesting is, here we were trending well below, same here. Actually, lately we have been slightly above those prior 3 years. You guys can see the holiday here. And this year we barely had a dip over the holiday. So kind of speaks to that relentless demand that we were referencing. How about on the pending sales side? Already I can see a huge difference. What I see just immediately is that 2020 in black has been well above the prior 3 years for several months now. It looks like maybe second half of June, all of July, all of August, and now half of September. So pretty impressive figures on the pending sales side. On the demand side, you guys will notice, buyer activity, buyers were a little bit concerned as well. You saw them pull back, but they easily surged to, they recovered and then got to, fresh highs for the year. And as I said, we've been trending well above levels from those prior 3 years. I don't think any of you guys will be surprised by that. Buyer demand, motivated by record low interest rates and maybe a perception that it's a less competitive market, during a COVID year, during a pandemic. I don't know if they're right, but there's a lot of perception out there, and it is a good time. It is a good time to capture some of those rates. The problem, as we noted, is of course a shortage of supply, low inventory. Let's talk now about year over year monthly change. So we were talking a little bit about weekly change there, year over year weekly. Now we're going to talk year over year monthly. So careful here, this is July. I'm going to show you guys August next. Here again, we can see this cutoff, this 250K cutoff, where under 250, we see declines in seller activity. Over 250, right, we see gains in new listings. So that's for July. August, not all that much difference. We still see that 250K sort of threshold where under we see losses in seller activity, above we see gains. I guess I noticed a little bit of a quieting down with that 750 up to $1 million price range in July. That one had 25% growth in seller activity. For August, only about 3.5%. So that's new listings. How about pending sales? So this is for July compared to last July. really remarkable growth in the luxury brackets, and we'll talk a little bit more about that. But you know, it's not just folks who are buying 250 and 350K homes. It's also folks in the luxury segments who are taking advantage of jumbo rates as well. For August, really not that much difference, guys. Pretty similar with July to August, July to August. So here is one key difference, and maybe it's minor, but I want to point it out anyway. Look at July, minus 5.33% contract signed between 190 and 250. August, little bit of a 4.5% bump in that price range. So it's nice to see some of these gains maybe filter down to the more affordable segments. Let's put this all together, folks. You guys can see change in new listings in gray and change in pending sales in blue. So what this says is for listings between 250 and 350, new listings in that segment only increased 7.7, while signed contracts were up almost 34%. One thing that I noticed right away, and I bet you guys notice as well, demand growth is outpacing supply growth in all price ranges over 250K. Demand growth has outpaced supply growth here and here as well. Don't forget here. And then lastly, here. Blue sales is consistently higher than gray, new listings. This tells us that demand is really overwhelming supply, that buyers are feeling, you know, more confident than sellers, and I guess more committed or motivated, if you will. Let's shift again now to part B, our monthly and long-term trends. Okay, I guess these are some of my personal favorites only because it really puts things in context. I like seeing, I like trending this back to 2003 so we can really see the run up of the bubble, the decline into the Great Recession, and then, you know, the growth since. Or as we're talking about new listings, the stagnation since. So for August, we did see a 2.5%, 2.75% bump, which is nice. But you guys will notice, you know, we're nowhere near these levels that we saw, you know, about 15 years ago. Now, some of this were condos that frankly should not have been built. These were during the bubble. This was kind of supply driven. So maybe our supply levels don't belong that high, but they clearly need to be higher than we're at now. Don't forget, we've had population growth since then, so we need more supply. Pending sales, how about on the demand side? August pending sales, I see 7234. I also see that is the highest number on our chart, telling us what? August pending sales were the highest, the record, it was a record high for any August going back to even before 2003. So again, guys, our data starts in 03. So I can't say with certainty that it's a record high since 2000, but I'm pretty confident that it is. Oops, one more note there, guys. So even though this was the highest August on record since at least 2003, it was also the strongest month for any month of any year since June of 2004. So just another note there. Closed sales, some of those gains in pendings are obviously kind of filtering into closings. Guys, closers are busy. There's refis, there's first-time purchase. They are busy. They haven't been able to add staff and add capacity. So I know some folks on that side of the industry, and they really are slammed. So be gentle with them. How about this one? August year-to-date pending sales. So not quite at an all-time high. I see 2016 stronger, and I see 2005 stronger as well. However, let's just pause and appreciate the fact that to have year-to-date pending sales up 4.5% during a pandemic year, I'll just say is pretty darn impressive. And I think some would be surprised by that. So even year-to-date, the first 7-8 months of the year were stronger than the same period, in I guess all but 2 of the prior years since 03. So a pretty strong figure there as well. CDOM, forgive me guys, I keep meaning to spell this out. I know not everyone is familiar with my funny acronym jargon. CDOM, cumulative days on market, simply market times. So you guys can see listings used to take almost 100 days to sell back in 2008, and that's a long time. Most recently, they're about 15 days. So what is that, 2 weeks in a day, about 2 weeks. Since this is a median, half the deals took longer than 15 days. The other half of the deals went under contract in less than 15 days. I think I actually should say fewer than. August original list price. So, we won't dive into this too much, but just so you guys can kind of see what's been happening there. What I do want to do is compare original list price to sales price. So, well, this is the June sold price where we see a 5% increase in price, right? That's June. How about August? 10%. Almost double the gain. So we do see some acceleration in pricing. And also note, guys, remember that original list price was $315, and that's just about the sales price as well. So pretty matched up there. In prior years, buyers are looking for a little bit more of a bargain. So if sellers are listing at 280, the buyers are buying at, say, 268 or 270, where they're focused on, more value priced properties or, more affordable product. So we talked about median, guys. I always get asked this, so I want to throw it in. What's the difference between median and average? Well, Bill Gates walks into a bar. On average, everybody just became a billionaire, right? Here's our 6 people. Those are their incomes, 30, 40, 45, 50, 60, 70. Oops. And then Bill Gates walks in with his $42 billion. Well, guess what? The average income in this bar is $6 billion. The median income is $50,000 because we had 3 people making less, 3 people making more, making this the median. You guys tell me, what do you think is a better representation of these people? A $6 billion annual income or a $50,000 annual income? I'm going to go with the median because the median had half above, half below. The average, 6 billion, had 1 above and 6 below. It doesn't seem like a good representation. That's why we like the median. Let's just apply this to real estate really quickly. Sales prices, right? Fairly common prices. Maybe we don't see all that many of these anymore. And I suppose not all that many of those. But let's just imagine those are our sales prices. Well, here we go again. Average sales price is $830,000, right? Would kind of sneak in somewhere here. The median, however, is $312,500. It's basically splitting the difference here. It's right in the middle. So 3 sold for less, 3 sold for more. Again, you guys tell me which number you like better for this set of sales, right? So only 1 of 5 records above the average versus half above, half below. This is why we prefer the median. A little bit of a fun, and I got to work in a Bill Gates joke, which is always good. How about PPSF, price per square foot, right? Sellers used to accept about $138 per foot of home. Now buyers are having to reach to about $160, $161 per foot. Just another note here. I like this example because I just think it helps drive it home. 2 homes, A and B, one price $200,000, the other price $400,000, right? Well, guess what? Those are not equal, are they? Well, neither are the square footages. The $200,000 home had 2,000 square feet. The $400,000 home had 4,000 square feet. So it's double the price, but it's also double the size. So price per square foot is $100 per foot for both of these homes. Now, not all square feet are created equal. Just because you double the square footage doesn't necessarily mean you double the value. But it's just an example, and I just think it's interesting when you're comparing these 2 homes. A buyer might say, and I know folks shopping around 200 probably aren't going to be shopping in the 400 range as well. But, maybe it's only 300 versus 350. If you look at the square footage and the homes and the finishes are relatively consistent or relatively similar, this is just one more tool in your toolbox, one more arrow in your quiver to kind of think about, comparing different homes. And price per square foot allows you to do that. So just one more tool. Oops, yes, sales price not equal, price per square foot is equal. So let's transition to percentage of original list price received at sale. This is for August. This simply measures the ratio of sold price to list price. So if I'm asking $300,000 for my home and I accept 270, I've just accepted 90% of my list price. If I list my home for 300,000 and I accept 330, I've just accepted 110% of my list price. And maybe that's not so common, although I'm sure it's happening in a few places. So 100.3%, that is a remarkably strong figure. And I bet most of you aren't surprised by that. That is the highest figure that we have on record. I think it actually tied, oh shoot, I think it's June or July of 2018. Don't quote me on that, I'd have to look. So 100.3%, yes, sellers on average are getting 100% of their list price plus 0.3% to be safe. Inventory, the big one, driving a lot of the change that we see in the market. And again, frustrating buyers. We showed that the number of active listings was down, call it about 30% from August of last year. So a lot of that inventory is being absorbed. It's not sitting, it's not lingering on the market, or as some would say, languishing. It's not, the product that's listed sells so quickly. We hear you guys say that some homes sell after 4 hours of being on the market, some 4 days, some 4 weeks, some 4 months. But many of the properties that are affordable, say under 3 or 350, that show well, that maybe are remodeled a little bit, depends on school district and a lot of other factors, but so much product that's listed gets absorbed so quickly. We've got Minneapolis here, year over year inventory. This is from Myers Research and it's only through July, so a little bit dated here. Forgive me, I don't have an update. But look at Minneapolis. So they're confirming down about 27% or so. And you guys can see just some other cities and how they're faring. Some have more dramatic supply declines. Some have less dramatic supply declines. Month supply of inventory. 1.8 months of supply, also down about 33%. Do you all remember when we had over 10 months of supply, right? So that's a buyer's market. Now that we have, really anything less than 5 months of supply is technically a seller's market. So we've been in a seller's market since 2012. The seller's market has tightened, right? It's even more of a seller's market where sellers are very much in control of this market. And they don't have to make concessions and they don't always have to make price reductions if they don't, if depending on traffic and activity. So let's just talk about this. Let's pause for 1 second. Sellers markets, less than 5 months of supply. This is where you have one seller, you've got pretty limited supply, but you've got 8 buyers who are really excited, really amped up, hands in the air. They're pumped. They're ready to buy a home, but there's really only a couple on the market, right? That's a seller's market. And you guys can see some of the other attributes of that kind of market below. Contrast that with a buyer's market where we have more than 6 months of supply. And here, as the picture suggests, you've got a decent amount of inventory, right? We've got 6 homes on the market, but we really only have 2 buyers ready to purchase those homes. So in this kind of environment, sellers have to make concessions in order to lure in those buyers. So they have to make those properties even more attractive. And then just lastly, a balanced market, maybe 5 to 6 months of supply, maybe even 4 to 7 months is relatively balanced. This is where you have 4 units of supply, roughly, matched up with 4 units of demand. Okay, let us jump into Minneapolis. Is this real? Is this what's happening? All these stories about people fleeing cities are total nonsense, says Jeff Andrews. I think that's from Curbed. Fortune, tales of Americans fleeing cities in droves, however, are likely overstated. City commentary, the exodus that never happened. The greatest urban myth of the COVID-19 pandemic is that fear of density has triggered an exodus from cities. The data actually shows an increase in interest in dense urban locations, so pretty interesting. Oh, sorry, this one's from Curb. No, the pandemic is not emptying out America's cities. Despite what cable news is saying every day, a mass migration to the suburbs just isn't really happening. From WNYC Studios on the Media, they also had a good podcast and article entitled The Urban Exodus That Wasn't. So this is from Zillow. May surprise some of you to see me quoting Zillow, but they did some interesting research. The share of Zillow for sale listings page views, and this is June, so again, a little dated, but they don't have an update. And so this is, rural areas, suburban areas, and then urban markets. In 2019, 21.2% of search traffic was rural. 2020, 21.4%, so a little bit of a bump there. Suburban, 62.6% last year versus 62.2% of listing page views this year. So suburbs down just a hair, and then urban areas, cities, 16.2% of page views June of last year, 16.4% of page views this year. A tiny bump, call it flat. If you watch the news and if you believe what some are saying, and even the highest levels of our national leadership, you guys would see that you would believe that 16%, well, it must be 2 or 3% now, and that's just not the case. So it's really important to have the facts to combat some of these inaccurate narratives, and might I add, somewhat politically driven narratives. Our friends at Finance and Commerce, I think, got it right. This is our friend Brian Johnson, end of July. To paraphrase Mark Twain, the death of the Minneapolis housing market has been greatly exaggerated. I just love that. I don't think I've read a better opening line, I don't know, in at least a few years. So I'll also throw in my own Mark Twain, one of my favorite Mark Twain quotes: if you believe everything you read, you had better not read. I guess I'll throw in my second favorite Mark Twain quote: don't let school interfere with your education. So new listings, guys, Minneapolis, let's take a look at what's happening. August of this year, August of last year, a pretty steep increase. May of last year versus August of this year, only about a 10% increase. So remember, guys, as spring market of this year was delayed because of COVID and shutdowns, the spring market from this year has been shifted into summer. So this summer market is really like last year's spring market. And I don't think you've ever heard me say this before, but that's why it's useful and perhaps better and more logical to compare this August to last May. We never compare Augusts to Mays. This for the same reason we never compare Junes to Decembers. There's a lot more activity in June. Go figure, right? I'll take things that are obvious for 400, Alex. So if you look at this, guys, when we compare to May of last year, it's really just not that much of a gain. But from August of last year, yes, it does look like a pretty strong gain. So just like we said, 2020 spring market has really become the summer market this year. Let's just do a little bit of trend spotting, if you will. Maybe this is part of a larger trend. Could COVID have accelerated a trend that was already in the works? The changes that we're seeing now in Minneapolis in terms of seller activity actually started back in 2017. So you guys will see 2016 into 17, little bump, into 18, little bump, into 19, little bump, and into 20, perhaps a bigger bump because maybe COVID accelerated some of that trend. Market shifts are usually first seen in cities, condo markets, and luxury markets, and then they kind of spread out to the rest of the market. So kind of interesting there. August new listings, Minneapolis. You guys will see single family, condo, and townhome. They're all up, I don't know, 40 to 50%. It's not like only condos are being sold. Some people think that everybody's leaving condos and going into single family, and it's actually fairly well matched up. Let's look at the sales side though. So here's where you do see some of that consumer preference shifting to single family. However, let's note that there was a 5.5% jump maybe 37% was a jump. There was a 5.5% gain in condo sales from this August to last August. I think if you told that to people on the street, the average person would say, baloney. There's no way that's true. But it is. And despite what you might hear or read, facts matter. Facts are there whether you like them or believe in them or not. Yeah. So let's take a look at July new listings. So that's when we did see a pretty big jump in condo listings, over 100%. But we're only talking from 22 to 45. So not big by numbers, but big by percentages. Oh, sorry, guys. This was Edina. I'm so sorry. This is not Minneapolis. This is Edina. So are people fleeing Edina? Sorry, sometimes I crack myself up. Are people fleeing Edina? I see a 27% gain in single family listings, 100% plus gain in condos, right? I don't think people are fleeing Edina. I just think you see some changes in the market. August numbers. So we're going to do some, well, we're going to get into some longer term trends, but we're first going to compare to some other cities. Let's do a quick time check. Okay, 9:40. Ooh, I got to hurry. So new listings, guys. This is August of the last 3 years. Here's where you see that big jump in Minneapolis. You also saw 17% in St. Paul, plus 19% Brooklyn Park, and about 18% in St. Louis Park. How about on the sales side, right? Well, let's go to Minneapolis. Nearly a 30% jump in contracts. So yes, we saw a large gain in new listings. We also saw a very large gain in sales. Pretty similar in St. Paul. So 28% there, 27% in Brooklyn Park, 35% in SLP. That's our winner. And then you guys can see Plymouth and Maple Grove. How about days on market? Market times. Everything's down 25, 30, 20, 20, 17, 26, 28. So everything's down. Minneapolis in particular, down 26%. One of the faster market times, so homes are selling more quickly. I have to just venture let me just make a conjecture here. If people were fleeing the city, I guess I wouldn't expect a 28.5% jump in sales, and I probably wouldn't expect homes to be selling in 26% less time. And I don't think prices would be rising at over 10.5%. And I would doubt that sellers would be getting 100.8% of their list price if everybody were fleeing the city. So let me just go back a little bit. So days on market, here we were on median sales price. You guys can kind of see, a lot of clustering around that 300,000 mark. And then Plymouth, with everything going on in Plymouth, some of the new construction on the west side of Plymouth, you guys will see prices highest there. And then Maple Grove, with all the new construction, you guys will see prices fairly high there. Don't forget about St. Louis Park. Seems to be on fire, more so than it had been, up 14%. But that's okay, because everybody's income has also risen 14%, right? Maybe not. So again, percent of original list price, you guys can see 100.8%, really a strong figure for Minneapolis, and really all these cities. As you see higher prices, you see a little bit less, 100.3 versus 101, 101, about 101, and yeah, all the 101s here. So let's take this back a little bit further. So now we're going to do some of that historical activity, putting August in context, but this is not the whole Twin Cities as we did before. This is just Minneapolis. So there's our 46% increase in new listings. Maybe highest since what, in 07? There's our 28.5% jump in pending sales, highest since what, 04? Hey, wait a second. Are you telling me that Minneapolis new listings are at their highest level since 2007, but pending sales are at their highest level since 2004? Can that be true? It is, my friends, it is. So this kind of makes sense because buyers remain more active than sellers, so they didn't have a ton of lost ground to make up for, right? Sellers, however, pulled back after COVID, and they never really got back to those levels from prior years. Finally, we're starting to see a release of that pent-up listing activity. And let's not forget, Minneapolis sellers in particular faced unique challenges getting properties online in June with everything that was happening. So perhaps it was the unrest that prevented sellers from listing in June and not encouraged sellers to list in July or August, because we know that some May and June activity was moved into July and August. Don't forget, since Minneapolis and all cities tend to have smaller and older homes, some buyers are looking for bigger and newer spaces. And we also do see some changes in the condo market, as we've noted. So percent of original list price, you guys actually saw a decline in August of 2019 compared to 18. So, that actually is weakening, but then we have strengthening, back to all-time highs. So sellers are getting almost 101% of their list price, really a remarkable figure. Even current list price, I had to take this not just out to the 10th place, out to the 100th place. 100.03% of current list price, not original, but current. So let's take a look at this one. Average percent of original list price by property. This is the whole metro. What I want you guys to focus in on is condos in red. So actually, condo sellers started getting slightly weaker offers. I believe it was actually July or August of last year. You guys can see this trending down a little bit. It's not just in the COVID era where you see changes in this condo market. I noticed changes in the condo market that started about a year ago, not just since March, April, May. So perhaps this is just a continuation. And also, despite that year-long decline, perhaps we're seeing some flattening out, which again might surprise some people in this COVID era. Similar so average, median. You'll notice single family and townhomes, have been pretty sticky. They've been staying at 100% for some time. Condos, a little bit of a difference here. This is a lot of text. Every good presenter will tell you never to do this, but here we are nonetheless. I won't read all of this. I just need you guys to have this. If you get the slide deck, for those of you who are watching on YouTube later, we just had to put this all on one page. So, seller activity is growing faster than buyer activity, even though buyer activity is also rising quickly. All of our other metrics are showing health and even strengthening in that Minneapolis market, as well as St. Paul, the other core city. So much of the increase, as we've noted, comes from activity that was shifted or postponed from May and June that appeared in July and August. So, there's obviously a mix of factors that drove that. Minneapolis has not seen a greater share of listings come on the market in the last 30 days, or actually even 60 days than St. Paul and other large cities in the metro. Some of this increase came from condos where there are some health concerns, especially for high risk folks with underlying existing conditions. Excuse me. And don't forget, with downtown condo living, guys, that's a lifestyle. So when the shutdown and the stay-at-home order came in, you had all those amenities and venues and events had temporarily shuttered. That really impacted a lot of the joy and value of that downtown lifestyle. People buy and sell homes for tons of reasons. As you guys know, there's so many other factors like more space. Maybe I need a second, third, or fourth home office with a spouse working from home and kids. Health concerns, interest rates, changing family circumstances, aging parents. How about financial hardship, especially if layoffs, so if job loss or income loss is affecting your family or household? Some of that financial hardship can obviously drive people to make changes in their housing situation. Guys, we only have a few months of data post-COVID. Well, maybe more than a few, but it's still a pretty short period of time to identify some of these trends and shifts. So sure, we're noticing some changes and we're talking about that, but it is still early. There's also a need for surveying, right? If you ask 100 people why they bought or why they sold, you're going to get a lot of different reasons. I don't know that you'll see a majority, I don't know that you'll have one single reason that makes up more than 50% of the responses. And don't forget, there's still a ton of demand for we've heard anecdotally, for every one household leaving, there may be 2, 3, 4, or 5 eager to get in. people who decided to list in June, they're going to be hard pressed to list their homes in July or even August. Most folks take at least several months to kind of get their home in a state that that they feel comfortable listing and their agent feels comfortable listing. So number 9, I'll ask this question: are people making a 10-year housing decision based on what could be a 9 to 18 month disruption? Another sort of interesting thought there. I hope you guys won't throw virtual tomatoes at me. I know I've got one more slide with a lot of text. Please don't be mad. So a few takeaways, just trying to sum up here. July and August were the months where a lot of that pent-up market activity was unleashed or released. We are seeing a reacceleration in price growth, as we noted, from 5.2 to about 9.8%. Market times are dropping, sellers are getting over list price, and as we saw, we've seen record-setting sales figures. We've been talking about this as well over the last hour. Inventory, the shortage is still a major concern and challenge. As we also saw in a couple different places, activity can vary dramatically by price point and by area. We didn't have time to go into all of our many wonderful cities and suburbs in the metro, but we encourage you guys to do that with our local market updates and or InfoSparks. Rates continue to be a huge incentive for people, especially first-time buyers. As we've noted, core cities may be experiencing a short-term disruption, even though there's strength in the markets. Some of these changes seem related to the health concerns, the closure of activities and changes in the lifestyle, and telework, a desire for more space for remote work. Civic unrest, sure, it may have played a role for some, but too many people are saying this is the only reason, and clearly it's not. It's not the majority. It doesn't explain the majority of the reasons. So condos, a lifestyle, not just a property type. And as we've noted, a lot of those benefits are on pause. Lastly, guys, I just want to say there's still a lot of uncertainty in this environment. So some of you may be asking, what's going to happen next, fourth quarter, what's going to happen next year? So much of this still depends on the course of the pandemic, right? Vaccine timing, schools, forbearances, job income growth, confidence, congressional action, or probably more appropriately inaction, business closures, changes in rates, and perhaps an election. I understand there's an election coming up. I understand there are strong feelings on both sides. And so perhaps that could impact the market a little bit. I will say, historically, elections haven't actually had a huge impact. Maybe activity quiets down just a hair, in the month or two before. But I think most of that is made up, later on in November, once, there's been a candidate has been successful. We will see what happens. And then I just want to say thank you so much for attending this month's COVID market update. I want to thank our sponsors again, Bell Bank, North Star, RCU, Royal Credit Union, and Supra. And before we close out, I think we have a few minutes for questions. Yeah, we got 5 or 7 minutes for questions. So hit me with your best shot.
Yeah, we can give people a minute to maybe send some in. Again, the chat or the Q&A function works for that. But I'm not seeing anything coming through just yet. I will just remind everybody that this recording and the slides will be available on our website, and we will send an email out with them to all registrants by either the end of today or tomorrow. So you will have access to all the information David has shared with us.
Well, gosh, if we have a few minutes, I can fill them.
Go for it.
Maybe while some of you guys are thinking about questions or just still absorbing the too much information that I shared with you, I just want to jump in real quick. So let's just hop into InfoSparks and kind of geek out together. So 3 years, let me go to my max. You guys can see if I go to the monthly numbers, right, there's our 9.8% jump in prices. We can see single family, 9.8, condos, only 1.6, townhomes, 7.7. So we can see differences there. Let me just get into my bar charts real quick, and let's just look at the different construction types. New construction homes cost a median of $405,000. Those prices were up 0.2%. And then on the existing resale side, previously owned properties, prices at 308 up an even 10%. You know, we can look at Minneapolis and St. Paul, and maybe we throw in a Bloomington just to get a big suburb in there. And you guys can kind of see some of the differences. So Bloomington prices up 5.2. Here's Minneapolis leading the packet up 10.5. You guys can see St. Paul. St. Paul, some affordable properties there still, not many, but you guys can see their median sales price a little bit more attractive to those who are shopping in the affordable brackets. You know, let me duplicate this real quick. And I want to show you guys something else. Let's look at size of homes. And for this one, let's look at signed contracts.
Looks like we have a couple questions coming in now, David.
Oh, we got a couple. Okay. I'll pause on this.
One is MOS of Minneapolis condos.
MOS, is that months of supply or MSI month supply of inventory? MOS. I guess I'm a little confused on that.
Let's see, I'll see if I can get clarification there. But a second one that came in was, what's the hope for more inventory for the first-time home buyers and those lower-priced properties?
Yeah, that's a good question. I mean, let's just take a look. You know, this is kind of one of the ways that I sort of break things down. And yes, I understand these are pretty broad ranges. And just in case you blinked, guys, I'm looking at our custom ranges. So if I click custom, I'm able to customize these price ranges. Let's just do a quick breakout. Let's look at homes for sale. And for this one, again, I'm gonna shift to my bar chart. So, right, change in, oops, sorry guys, 12 months. I wanna just look at August. Okay, here we go. Inventory, active listings under 250K fell over 41%. From 3,200 actives down to about 1,900 actives. We do see fairly dramatic declines in supply as well, for 250 up to 500 and 500 up to 1 million, right? A little bit less of a decline as you get over 1 million. So I guess what I'd say is, I think you're going to be hard pressed to find some of these products come online. And again, let's just look at new listings. You know, new listings down 17% in this most affordable segment. And check this out. You see gains in all other segments on the new listing side. So really, you know, this segment kind of continues to decline. And, you know, let's just think about maybe why. If I own a home that, you know, maybe I paid, I don't know, 150 or 175 or 200 for, you know, and I don't care when, because I like my payments, and I don't care what it's appreciated to, because I'm going to really be hard pressed to find another home in a location I want, even though locational decisions have changed a little bit with remote work. I'm going to be hard pressed to find a similar home, you know, where I want to be at a similar payment. So, you know, if supply were more ample, I think you'd see more churn, more turnover in this segment. One caveat to that might be, if we do see an additional wave of, you know, changes in the economy, changes, perhaps job losses or further income losses to certain households, you may actually see some of these folks have to list. Perhaps some, you know, are forced to go into rentals. You know, I don't know how common that's going to be. I'm sure it's going to exist. So depending on the course of the pandemic and what happens in the economy, you could see some changes. I still think I wouldn't bank on seeing inventory gains in this most affordable segment. I just wouldn't. And if you look at month supply, yeah, 1.1 month of supply. So just about 1 month of supply versus 1.5 in this next range, 3.5, and then actually almost 9.5 months of supply as you get over $1 million.
Do you have any insight as to why listings are down in a strong seller's market?
Yeah, I mean, I just think it's a game of musical chairs. I'm not going to give up my chair until I have a place to sit down. There's just so much concern over that. And I might add legitimate concern. You know, I know that's part of what's driving this. So someone asked me last time, Why so few sellers and why so little inventory? So I do have a quick list of 14 reasons. I'm not going to bore you guys. I'll spare you. I won't read them all. But one, a lack of confidence in my ability to secure my next home in such a highly competitive environment, right? I'm not going to sell my affordable home because I can't find anything similar at a comparable PITI payment, right? Also, we're staying put for an average of 10 years versus 5 to 7 years previously. Some of these factors that we've discussed might be preventing a move and leading a lot of folks to hunker down. I said I won't read them, so I'll stop there. But there's a lot of other reasons, you guys, of why inventory and new listings are so low.
Yeah. And so MOS, it was months of supply with the first question regarding Minneapolis condos. And then one last question here. In the beginning of this webinar, the data was showing a significant decrease in inventory. Then at the end, it was showing an increase in new listings. Don't these numbers contradict each other?
Good question. So one thing that I didn't show, because there's a lot of product, well, not a lot of product, but because these 2,200 were down, and some of the gains in the other segments, even though they might be large percentage gains, they're really not large numbers. So if you look at all, that's where we got that 2.7% increase in new listings, even though this range was down 17%. So if you look at inventory, again, overall inventory was down 30%, even though million plus inventory was only down 11%. So actually, you know what? I'm gonna shift gears. This is actually a better place to see this. Let me go to my monthly indicators real quick. So this is just our static PDF report, but I want to show you guys new listings. So year to date, down 4%. However, when we ran this data, they were up about 1.3%. So just kind of looking at this, guys, so Feb and March, we actually did see some gains. And then after COVID, we saw 20% declines. Now we're finally starting to see some modest gains as well. However, over the last 12 months and year to date, seller activity is still down. Let's shift over to active listings. Sorry, guys, I know it's a lot of scrolling. There we go. So, actually, March of this year, we saw a gentle increase, actually the only increase over the last 12 months. As we got into May, June, July, and August, you saw these inventory declines increase, right? So the rate of inventory contraction has only gotten more dramatic. And that's because, of course, seller activity is up a little bit, but still pretty weak. And buyer activity is absolutely relentless, both for the month and for the year so far. So that's going to be, what that tells us is that buyers are absorbing so much of that inventory that's active and that's new that there just isn't much left. So it's driving down those numbers for active listings. I think I understood that question right. Hopefully that makes sense. Others? We're feeling okay? All righty. Well, I want to just say thanks again for joining us. Really means a lot that you guys spend some time with us. I know your time is precious. And as Ann said, just a quick reminder, we will have a recording on our website shortly. And then we really encourage you guys to join us next month as well. Check out our website. It's right on our calendar. Just be sure to register. And with that, I'll say, please use the data for good and never for evil. Thank you, guys.